Good afternoon. Thank you for joining the AI Insight panel discussion, Alternative Mutual Funds. I'd like to start by introducing Lou Johnson. Lou is our alternative investment analyst who is responsible for developing AI Insight's recently launched alternative mutual fund functionality, which includes fund-specific research reports integrated into AI Insight's existing platform for subscribers to leverage the features that they're already familiar with, such as comparative reports, financial performance reporting, and the Phoenix expense reports. As part of this launch, he has also authored a comprehensive CE credit qualified AMF education module and strategy-specific short courses to help financial professionals better understand AMFs and meet their training requirements for these complex products. Lou?
Wonderful, wonderful. Well, thank you, Jen, and good afternoon, everybody. Thank you for taking time out of your busy day to join us for our monthly webinar series, this month focusing on alternative mutual funds. This is a topic that really garnered a lot of attention following the financial crisis of 2008, and given the losses we experienced in the equity markets, as well as interest rates subsequently falling to historical lows. These factors really helped drive investor demand towards more diversified sources of return, especially those that could provide the potential for downside market protection. And while investment-grade fixed income can still provide this potential, returns have been challenged, by this low-rate environment we find ourselves in. So insert alternative investments since 2008. Alternatives, broadly speaking, have seen an increase in their role as portfolio diversifiers. And one of the industries to see really increased flows from this was the alternative mutual fund space. And, the product, really, the benefit there, it was designed to expand this risk-reward opportunity set available to investors, but while also providing the daily liquidity and investor protections afforded by the Investment Company Act of 1940. However, following a high growth period we saw from 2007 to 2014, the industry has been met with some challenges, and more specifically, performance has been challenging in the face of A, the strong equity market, and two, the amount of dispersion in performance we've seen across managers. There's also a lack of standardization across the industry and how funds can be sourced, as well as benchmarked. And the products, they're complex, which requires increased resources for performing due diligence and investor research. Lastly, the complex nature also creates regulatory concerns for investors, which at this point are not well understood by the industry. Well, to discuss the product set as well as address the above concerns, among other topics of discussion, we have assembled a well-rounded and experienced group of panelists. These include Alfredo Gomez, a managing director at Snyder Kearney, LLC, Christo Stefanov, an investment director with Cetera Investment Management, as well as Monica Mehta and Michael Grayson of Vivaldi Capital Management. So the format for today's call includes a formal Q&A session, which each of our panelists. We also have some broader industry. We also have some broader industry questions for the panelists as a whole. And we will then make time for the audience to ask questions for our panelists before wrapping things up. So one last thing I would like to note before jumping in is just a point of clarification. There may be various terms used today to describe alternative mutual funds, including AMFs, alternative funds, alternative mutual funds, liquid alts. Just want to be clear, these are all referring to 40 Act mutual funds with alternative investment strategies, the topic of today's call. All right, so with that, we're going to jump in with our first panelist. Alfredo Gomez is a managing director with Snyder Kearney, LLC, a law firm that provides due diligence services to broker-dealers and registered investment advisors, where he focuses on enhancing and developing advisor-focused research products for alternative investments. Prior to, Alfredo also served as AVP of Alternative Investment Due Diligence with the broker-dealer National Planning Holdings. Alfredo, thank you for joining us.
Yeah, thank you, Lou.
So let's just maybe jump right in here. first question for you, Alfredo, is what are just some of the key due diligence items to consider when reviewing AMFs?
Yeah, thanks, Lou. And just to quick disclosure that my comments today represent my opinions and not the opinions of my employer or its affiliate. And Lou, I did put together a list here of different things that I think are important due diligence aspects to look at. So I'll briefly cover some of these. Some of these are unique to AMF. Some of them are kind of similar to traditional investments. You just have to be more careful. So I think it's important to understand the strategy. How will it deliver the alpha? Is it meant to reduce risk or increase returns, which could increase risk? And the way I like to look at it is if I can't explain the strategy in an elevator, then I don't really understand the strategy and I need to go back and read some more on it. An example that I've seen is a managed futures fund that goes long short one index using futures. And that's not really a managed futures fund. It's more of a long short equity fund or even a market timing fund. So that's an example of where you need to dig in a little bit deeper and understand the strategy. You also need to understand the track record and the reason for the high fees. How does it differ from less complex, less expensive funds like mutual funds or ETFs? Does the track record show that it's delivering on its objectives? Why did it outperform or underperform? An example here is a global macro fund that charges higher fees, but upon further inspection is really just a global allocation fund. So instead of the global macro fund, you can go into a global allocation fund with a lower fee. You also need to evaluate the management team and the reason for launching the fund. If the fund is compared to a hedge fund, can it actually replicate what was done in the hedge fund? Even if the hedge fund strategy or the hedge fund track record shows up in the prospectus, I think that's still a valid question. Can they still replicate what they had done before? And if the hedge fund is still around when they launch the mutual fund, how are they reconciling the two fees? Are they lowering the hedge fund fees or are they increasing the mutual fund fees? A few examples here might be a hedge fund that had a really good performance one year, but it now is starting to lag and maybe losing AUM, so the fund company launches a mutual fund. Another example is a mutual fund might focus on more liquid names and lower leverage and can't replicate the hedge fund strategy. And then you might have some funds that focus on Bitcoin and blockchain, which can't really deliver the exposure. It's just kind of a short, kind of a tech-focused one. So a few other items to pay attention to is the fund structure. Are there swaps? The swaps might be hiding some fees that are not showing up in the fee structure. Understand the derivatives. For example, VIX, short-term VIX is really expensive, but tracks the volatility better. Long-term VIX futures are cheaper, but don't really track the VIX very well. Understand the shorting. Shorting is expensive. You give up the dividends, and it should be short-term. And then there's also more regulatory scrutiny on alternatives, and you have to pay attention to collateral management and counterparties. So I think those are, sorry, I think I took a little too long there, but those are some of the aspects I think are important.
No, that's perfect, Alfredo. All very important. Maybe more specifically than the next question, are there any maybe major red flags that you should be looking for more specifically?
Yeah, so kind of along the same lines, so I mentioned like blockchain. I think anything that's a hot investment right now should be a red flag. Doesn't necessarily mean it's a bad investment, just that you need to understand why is that being launched. Is it being launched just because it's a hot investment, or is there an actual fundamental reason for it? Anything that attempts to time the market should be a red flag. And there's different approaches for that. There's all kinds of different ways. I mentioned one that does the managed futures that goes long and short one index. There are some that explicitly say they're trying to time the market. If the track record seems too good to be true, or if the correlation and risk metrics seem too good to be true, then they probably are. One example, like market neutral, if you look at correlation and the risk metrics for market neutral, they look really good, but that's because returns have been horrible. So that's the reason that the correlation is low. If the track record hasn't gone through a full market cycle, which is actually a lot of strategies right now, then that should be cause for more consideration. Even if it's been back tested, you want to understand that until you actually go through a bad market, the fund won't be fully tested. So with that, if the fund managers are emphasizing a back-tested track record, then that would be a red flag. Every back-tested track record looks good. If you want to make sure you understand that what hypotheticals went into that. Star manager teams, not necessarily a red flag, but something to look into. Alternative investment funds tend to be complex, so usually they need a big team. Usually you want a big team behind the star manager. If the fund is relying heavily on derivatives or leverage, you want to understand what that does to the downside risk. And then if they have significant investments in illiquid securities or securities that could become illiquid. So a good example of that is the Third Avenue focused credit fund from a couple of years ago that blew up. It had a lot of distressed debt that was liquid until it wasn't. So those are just some examples.
Perfect. No, it's very helpful, and I appreciate the use of using specific strategies to help make your point. And along those lines, as the next question, just given such a broad space, maybe we'll take a step back here for a second. If you could just help provide some insight on the different strategy types, broadly speaking, that get lumped into this alternative mutual fund category, and maybe a little insight as well on how they differ from more traditional liquid alternative offerings.
Yeah, so I won't outline the individual strategies. If you go to like Morningstar, Lipper, or the AI Insight website, I think you can see all the different strategies. So I'll kind of give more of a high-level breakdown of how I see them. So one way that I see them is alternative assets versus alternative strategies. So AMF can't access some of the assets directly, like infrastructure, private equity, and real estate. You do have traded versions of those, but they can't access them directly. On the strategy side, AMF have liquidity constraints, so they can't invest in some things like distressed debt, and they can't have as much leverage. Maybe they can invest on the really micro-cap companies. And the investment horizon can't be as long, so they can't go into private equity and invest for 5 to 10 years because there might be some liquidity needs in the meantime. The other way of looking at it is absolute versus directional strategies. So on the absolute side, you have something like arbitrage, market neutral, managed futures. On the directional side, you'll have bear market, long short equity, global macro. So those are two different approaches, and that you see both on the hedge fund side and the AMF side. But usually on the AMF side, when it comes to volume and fees, AMFs go more for high volume, lower fees, whereas hedge fund managers tend to go, or illiquid fund managers tend to go for lower volume and higher fees. And the general idea here is that illiquid alternatives are trying to capitalize on undiscovered beta, illiquidity premium, and maybe better skill. So that's kind of a general overview.
Perfect. And along those lines, it definitely tees up the next question here. Given some of the differences in fee structures you mentioned, what are some of the incentives for these institutional managers we're seeing on the hedge fund side that are entering this space, and what has sort of been the impact of this shift?
Yeah, so in my experience, and there are studies on this, but in my experience, there's kind of two major reasons. One is that there's been a shift from defined benefit to defined contribution. In other words, from pensions to client-directed accounts like 401ks. So the pension market hasn't been growing as much as the 401k market has, for example. It's requiring a different approach. You don't have for the 401k market. You need to have these more liquid investment strategies, and that's why you're seeing a shift of managers wanting to launch mutual funds instead of or in addition to their illiquid strategies. The other reason is access to a wider set of investors. So pension investments tend to be pretty lumpy. So you can either thrive or starve. Whereas if you have a wider set of investors with mutual funds, for example, then it can be more stable over time, a little more consistent. So those are kind of the two big reasons that I've seen.
Perfect. All right. Well, thank you, Alfredo. Much appreciated insight from that due diligence perspective. We're now going to shift gears to investment research. Our next panelist, Hristo Stefanov, he is an investment director with Cetera Investment Management's Portfolio Solution Group. His role includes generating actionable insight on a variety of broad market topics and on how to implement specific investment styles in investor portfolios. A major part of his duties involves incorporating the research team's overall market outlook into portfolio construction and risk mitigation ideas to be used in Cetera Investment Management's strategic as well as tactical asset allocation strategies. Hristo, thank you for joining us.
Thanks, Lou, and thanks very much for having me on the call. Also, thanks for the great introduction. The one thing I wanted to also add, perhaps, is that even though right now I'm focusing more on portfolio construction as well as overall guidance of the manager research team here, historically, going back a year or two, I was the analyst actually who was responsible for the mutual fund selection in the alternative space for Cetera Investment Management. So my comments are going to be focused mostly, similar to Alfredo's comments, on the 40 Act space, but I will kind of try to speak both from the view of an analyst who covers the space, as well as how to implement the portfolios that we select within the funds we select within a portfolio context.
That's perfect. So maybe along those lines, coming from that point of view, we can just start broadly speaking and just maybe touch on how Cetera defines the AMF opportunity set and what are your expectations for the space when considering for an investment?
Absolutely. Thank you very much for the question. From our perspective, we broadly define alternatives into two sets, and we're going to focus on the second set. The first set is kind of traditional, long-only diversifying assets. This is maybe consists of real estate, commodities, perhaps infrastructure. These are non-traditional assets. They're different than equities, different than fixed income. They behave a little bit differently, but the one thing that we've seen is that they tend to be in economically sensitive sectors and generally speaking may also sell off in periods of crisis. What we are trying to find in the alternative space, and to some extent I'm also going to echo some of the previous presenters' comments, we're trying to find alternative investment styles, something that provides diversification not only from a different asset class perspective, but also diversification in the sources of return. So what we're trying to find is very skilled managers that are good at several different things, including shorting. That it has a couple of investment styles we focus on, equity long short, market neutral, in some cases event-driven strategies that may include either merger arbitrage, convertible arbitrage, or something that may have to do with different events such as acquisitions and things of that nature that happen within an organization that may drive investment results. We focus on trend-following strategies, and in trend-following managed futures or similar strategies are frequently given as an example. We also focus on global macro strategies, funds that look at asset classes such as global rates, credit, and currencies as well, and try to basically impart a manager decision that would derive value from these different categories, going both long and short on different sides of the spectrum, as well as positioning on a geographic perspective in areas that are likely to overperform or underperform. and that's manager skill in those areas we feel offers a diversified source of return, which can then enhance portfolios. And this is most of the discussion that I'm going to lead to today. The second thing that I wanted to kind of bring into the discussion as well is how do we use alternative investment styles. And generally speaking, what we try to do is we try to use alternative investment styles or alternative mutual funds as a diversifier. We are trying to lower equity risk in portfolios. And the reason we do that is because equity risk or equity-related risk is the biggest contributor to overall volatility in a portfolio. When we take a look at our portfolios that we manage for clients and we advise for clients, maybe about 80 to 90% of the risk is driven from the equity exposure. Fixed income tends to be a lot less volatile, tends to deliver a smaller portion of the overall portfolio volatility. And what we're trying to do with using alternative investment styles is to lower the overall volatility of the portfolio. What we have found out is that by using alternatives, we can meaningfully reduce overall risk, typically about anywhere between 8 to 12% reduction in overall risk. So for a moderate portfolio, which may have a risk close to about 10%, by using alternative investment styles, we can bring that down close to a 9% overall volatility on a forward-looking basis. And to speak about expectations about the asset class, we expect about a Sharpe ratio anywhere between 0.5 to 1, and our expectation is about roughly 6% return over the intermediate term, maybe with about 10% volatility if you take a look at the multi-manager portfolio. In alternatives, for some of the other asset classes, we have a little bit more nuanced, like equity long-short and things like that. We may have to be specific to the manager we use. But generally speaking, we expect alternatives to deliver a relatively high Sharpe ratio. 1 is great, but maybe slightly under 1 over the course of a cycle, with not a substantial detriment to portfolio returns.
That's perfect. Very valuable insight there, Hristo, and that really kind of sets up this next question. You really, in that previous response, it really helped showcase that just the versatility and the breadth of this space. There's a lot of different strategies available that can be used in a lot of different ways. And so just maybe along those lines, can you maybe discuss what are some of the challenges just in sourcing and utilizing AMFs, in this regard from a portfolio standpoint?
Yeah, I think, and I think also Alfredo mentioned this earlier as well, so sorry to kind of repeat. I think to some extent we're going to be echoing each other in this conversation, and since most of the issues I think that we have faced in the area are very similar. In the 40 Act space, there's relatively limited availability of certain investment styles. Private equity, private real estate does not conform to the 40 Act space, doesn't conform in the rules. So those are difficult to source and sometimes not available. And then additionally, there's less availability in certain asset classes. Equity market neutral is a tricky asset class to find managers in. And in some areas, many of the strategies that exist tend to be relatively new. There's a couple of strategies that have been launched in the 40 Act mutual fund alternative space that have maybe not been as successful, and they have closed. So the one thing that we are finding a little bit tricky in the 40 Act alternative space is that it's the availability of good managers is maybe not as strong as it perhaps it exists in the hedge fund space, which is available to high net worth individuals. This is not a detriment of using alternative investment managers. And we quite honestly feel that one of the ways to get around maybe the lack of availability of some strategies is to use a diversified manager or a multi-manager approach where you have a manager of managers who then selects sub-advisors from the hedge fund space and puts those into one mutual fund. That's a multi-strategy mutual fund. And from a portfolio perspective, multi-strategy mutual funds actually tend to work a little bit better because what they do is they give you a diversification, they give you manager risk dispersion, so you don't have to worry about whether you picked the exact right manager because you have somebody who, first of all, has done another layer of due diligence and also has picked maybe 3 or 4 or 5 managers that are diverse in their style. So the access that we find where we have limitations, we have to use more multi-alternative funds or multi-strategy fund, if you will. And then for some of the other strategies which we currently like, such as equity long-short, we tend to find managers that are specific to their style. One of the things that I wanted to speak about as far as other challenges in this space, in the long-only space, due diligence in mutual funds tends to be somewhat simpler. In the alternative space, I think people have to really understand each manager, and they have to have conversations with each manager on an ongoing basis in order to make sure that they understand the manager style, they understand the limitations, and they also understand how that manager may compare to other managers based on their approach. For example, in shorting, does the manager short individual securities, which tends to be more diversifying, or do they just short securities using a future or shorting a broad market by shorting an index? In managed futures, for example, we would like to figure out if the manager actually is trading the futures market directly, or are they using a total return swap? If they're using a total return swap, which still exists, I think, in that area, that tends to be a little bit more expensive. There may be sometimes a perception of fees that are not fully disclosed, so we tend to avoid those areas. And then for multi-strategy funds, we definitely want to understand that the manager of the multi-strategy approach has good risk controls, has the ability to effectively change managers, or if they fire one of their sub-advisors, they have the ability to immediately take control of the trading assets. They have the capability to trade those assets, and then they can transition them to another manager on a very short notice if that is necessary. So those are some additional operational constraints that people have to be aware of when they review managers in that space.
That's great, Hristo. Thank you. Let's shift gears a little bit then and talk about the other end. How does Cetera monitor AMFs on an ongoing basis, and what are some of the challenges there in assessing overall performance on an ongoing basis?
Absolutely. Thank you for the question. I think this is one of the tricky areas because in the 40 Act space, there's, as we mentioned earlier, less availability of comparable funds. I think it's relatively easy in the long-only space to pick an asset class, pick a representative benchmark, and then compare people or managers who are managing within that asset class who then manage relatively close to your selected benchmark. In alternatives, benchmarking is a little bit broader. In some cases, strategies are not very close to each other, so peer-to-peer benchmarking is difficult, and then finding the right benchmark also can be difficult because even though benchmarks exist, they tend to be more focused on the hedge fund space in these alternative approaches, and there's a little bit less availability of benchmarks that maybe cover each individual subset of managers. There has been some development in this space. Morningstar has been launching some alternative benchmarks that we've looked at. Wilshire has also launched some alternative benchmarks over the last couple of years. But the way that we do it, we tend to do two things. On an internal basis, we compare each manager to the HFRI benchmark that is specific to their asset class. That is not something we can always publish because many of our advisors use Morningstar, and in Morningstar, HFRI requires an additional subscription, and it's not always available to everyone. So we also compare managers relative to cash in order to evaluate their absolute return approaches. And on a risk basis, we evaluate Sharpe ratios, as I mentioned earlier, and for some of the mutual funds that are a little bit more long-short oriented, we take into account the net exposure in order to determine how much alpha they have delivered over the course of time.
Great. Wonderful. All right. Well, another question I'd like to ask is also, what are some of the key considerations then that go into determining how much to allocate to alternatives within a portfolio / model?
Absolutely. So from our perspective, if the first decision that needs to be made is why use alternatives in a portfolio. And as I've mentioned earlier, we tend to use alternatives as an equity diversifier and to lower overall risk in portfolios. Some other approaches, we tend not to use it as much because they tend to be more tactical. But some of the other approaches we've seen is to use a particular style when they may be a benefit to that particular manager's investment approach. So, for example, if an economy is starting to boom and it's maybe late cycle economy when merger activity is increasing, using a merger arbitrage approach may be more meaningful. In some areas, when people were worried about rising interest rates, that was happening mostly in the end of 2017, most of last year, using a long-short credit to protect against rising interest rates more tactically. Those are some of the approaches that we've seen. But from our perspective, the easiest and probably the kind of more universal approach of using alternatives is to diversify the overall return profile of a portfolio and to lower risk. And with that in mind, we tend to suggest using a meaningful amount. So if you are putting 1 to 2% of overall portfolio assets to an alternative investment, that tends to be a low amount. What we do is we allocate about 10% of equities to alternative investment styles. So, for example, if there's a 60-40 portfolio, we take 6%, 60-40 portfolio, 60% being equities. We will take 10% of the equity exposure, which is about 6% overall, and allocate that to alternative investment styles. And right now we use a multi-manager approach as well as a long-short equity approach to fill those positions.
Wonderful. Wonderful. Well, great. Well, thank you, Hristo. Valuable insights. So I think at this point, we've spoken with now a due diligence specialist, an investor research specialist. Now let's shift gears to hear perspective, from the investment management side of things. Our third and fourth panelists, Monica Mehta and Michael Grayson, are both with Vivaldi Capital Management. Vivaldi is an investment advisory firm specializing in single and multi-manager alternative investment portfolios. The firm manages approximately $3 billion in total assets for high net worth investors, institutions, and advisors. And their platform also includes more than $600 million in alternative mutual fund assets, including their Vivaldi Merger Arbitrage Fund and the Vivaldi Multi-Strategy Fund. Monica and Michael, thank you for joining us.
Excellent. Thank you, Lou, and thanks to the AI Insight team for hosting us.
Okay, wonderful. So let's maybe start as well, similar from a broad strokes standpoint, and how do you define the AMF opportunity set, and what factors were most important when bringing the strategies you offer to market?
Sure. And as you mentioned, here at Vivaldi, we do specialize in alternative and multi-asset class portfolios, really with a philosophy of differentiated and uncorrelated true alternative return streams. And we use this framework to really assess our products from a business development standpoint and really look to pursue those areas of the market that often exhibit inefficiencies. With that, we are cognizant of limitations within the 40X structure, which is what we've been talking about when it comes to liquidity and leverage, and really take that into account. And as the other panelists mentioned, really want to ensure that we are delivering a true alternative strategy and not necessarily a watered-down version of an alternative strategies. We do feel some others tend to ignore the liquidity constraints and maybe shoehorn into this construct. And therefore, with that in mind, we tend to focus on a subset where these constraints make sense. So, i.e., you mentioned our merger arbitrage fund. That's sort of an equity-oriented strategy that doesn't inherently run any leverage. So the constraints on the 40X structure did not impact the investment process whatsoever. And same with our multi-manager fund, same as Hristo mentioned. We are looking at strategies which not only fit the construct, but the fact that it is a multi-manager sub-advised portfolio allows us to look at some differentiated return streams.
Wonderful. All right. So from maybe next question then, how do you view alternative mutual funds from a portfolio standpoint? As an example, do you see these more as portfolio solutions or more individually defined opportunities, maybe both?
Certainly, yeah. I think we do view them as both. Just from a portfolio standpoint, whether you're looking for an alternative strategy really to fill an asset class bucket within an overall asset allocation portfolio for a client, or on the flip side, if you're looking at an individually defined opportunity, the bottom line or framework that we begin with is really being confident that the strategy can generate some returns without market directionality. Again, just reinforcing the same points that the other panelists have made, but we don't want to see any underlying factor exposures such as market cap, sector, style, i.e. growth versus value, nor do we really want there to be any equity or fixed income beta as well. I think that's really important point to take away, in that many alternative strategies, even within the market neutral category of Morningstar, other reporting agency categories, do have some equity or fixed income closet beta that doesn't always present itself, especially during benign market environments. With that said, we also do think there are a lot of strategies that are good third pillar allocation or standalone line items within an investor's portfolio. So just to present a few, and to try and not be redundant, take merger arbitrage, for instance. This is a strategy that we know intimately, of course. But the portfolio is, as Monica mentioned, inherently a book of equities, so simply owning companies involved in merger transactions. However, the interesting thing about merger arbitrage is that although you own a portfolio of stocks, the strategy or individual stocks that you own are completely immune from market and sector fluctuations if the strategy is implemented with the appropriate hedging strategy on the short side. From an investment perspective, the way to think about implementation in a portfolio is really, okay, once a merger or an acquisition is announced, the market risk of that company that I now own is really being replaced with deal completion risk, right? So that's the risk that I'm inserting into an investor's portfolio, not additional or commensurate equity beta. In addition, on the fixed income alternative side, so you can think about merger arb being an equity alternative. On the fixed income side, we do think there are alternative income strategies like, take for instance, structured credit, as well as some other leveraged credit strategies that can generate healthy income really without adding commensurate interest rate risk to a portfolio. So similar to merger arbitrage, where you're owning equities without taking directional market risk, structured credit managers, when employed the way we like it to be, can often own a basket of fixed income securities while remaining relatively neutral from a duration perspective. So for those reasons, we do view there to be different ways to implement alternatives. I mentioned merger arb and structured credit, which we think are good ways to complement traditional exposures. But you can be flexible in building a client portfolio.
That's very helpful. So maybe taking a dive into something a little more specific. What is your philosophy then on risk management from a risk management standpoint within managing an alternative strategy? And are there special considerations that must be made on the asset manager side in comparison to a traditional strategy?
Sure, and a lot of our thoughts echo what the previous panelists mentioned. But for us, it's really important to understand sort of the full range of outcomes from a risk management perspective for each of the sub-strategies and really understand the return streams. And we'll talk about it later, but I think you also mentioned benchmarking, sort of what makes sense for each strategy is what we really focus on. As you mentioned in the beginning, these are complex. They're very different than your traditional strategies. So, for example, an equity long-short strategy has a very different risk parameter when compared to structured credit. And we really take a diligent approach in unraveling each of those strategies to understand the real risk element inherent, and particularly how they'll perform in various stress periods. We want to be acutely aware of potential negative outcomes. We're not looking to introduce extra volatility into a portfolio. So really understanding what you're getting is a large part of our work. And for example, in the multi-strat portfolio, we want to ensure that there's no overlap in strategies from a risk perspective. and taking that into account. If the worst case scenario for a few of our underlying strategies is the same, that could be a problem, and that's how advisors should think about it as well, is really sort of the stress periods and downside risk as well.
Yeah, and I'll just add briefly on top, I completely agree with and echo Monica in that monitoring and risk management should really be informed by the flexibility that you're assigning to each alternative strategy. But it does certainly take a lot of maintenance. So if you're looking to potentially carve out an allocation for alternatives, you should just be aware of the bandwidth that requires. So just to let you know, our process, take away a few helpful elements of it, really involves preparing and codifying formal weekly commentary on a management of all of our alternative strategies. So from a risk management perspective, that involves reviewing overall portfolio performance, sub-manager performance, any allocation changes we're considering, policy weights, as well as circling up on watch list items. So I think codifying watch list items is really important as you're evaluating strategies on a go-forward basis. And the main goal there is to really identify, whether it's on a weekly snapshot or a monthly snapshot, if there's any outlier return or attribution information that really warrants additional investigation. And from there, you can really start to better evaluate and risk manage your alternatives portfolio. Briefly, I do, just because there's been so much said already, we do want to just spend a second on, from an asset to liability perspective, mismatch perspective, we think it's worth mentioning a fairly underutilized strategy that's still in the registered fund space that many alternative managers are employing today. It's not open-end mutual fund, but it's instead closed-end interval fund structures, potentially worth getting up to speed on. The reason being, we for many years, as previously mentioned on this call, alternative strategies could really only be accessed through limited partnership structures. But those private funds, while they had the ability to construct a portfolio of less liquid assets that a lot of times provide liquidity premiums as well as a true uncorrelated nature to equities and fixed, are only available to QP purchasers. So you have to have an investable assets greater than $5 million. In addition, I know it had been mentioned the Third Avenue Fund, which owns some hard-to-trade or outright private assets, and that $1 billion fund was forced to sell those assets at a large discount to a strategic buyer. That is the worst-case scenario for an alternative mutual fund, where you're owning hard-to-trade assets that are less liquid. So for that reason, we've seen the demise already of that large daily liquid mutual fund. The limited partnerships are a little bit harder to access across your client base. So for that reason, we think interval funds are a prudent way to access some alternative asset classes that you can't in a mutual fund, i.e. private equity, real estate, as well as some less liquid credit.
That's perfect. That's it's very helpful. All right, well, wonderful. Well, thank you both. Very helpful information. All right, I just want to say thank you, everyone, for staying tuned. At this point, we're going to jump into some more broader industry topics and their impact on the alternative mutual fund space. These questions will be more meant for all of the panelists, after which we will definitely try to make some time and open up for Q&A from the audience as well. So with that, my panelists, I'm just going to jump into the first question here, being if we can just talk about performance challenges this space has seen since 2008 in the face of this equity bull market we've seen.
Sure, Lou. We can start with that, Monica from Vivaldi. For us in that space, so as you alluded to, extracting risk premium since 2008 has been very difficult. There's basically been two sizable equity market corrections since 2008, and they were pretty macro-driven. So, it's been challenging to find pockets of inefficiency to then create the right type of alternative strategy. And as a result, there's obviously been subpar product out there in the alternative mutual fund space. We get that advisors have had a negative experience, and that's where we're trying to, again, deliver at least a strategy that makes sense. advisors previously probably got sold alts that aren't alts, as we've all alluded to. And for us, it's about creating, impactful and true product which remains in the 40 Act construct, and educate our prospective clients on that. So I'd say really the challenge has been not just from a performance perspective, but a product development perspective to ensure that we are hitting pockets of inefficiency in the market, but again, within that 40 Act construct, which creates asset and liability limitations that Michael mentioned earlier, and really understanding the cyclicality of each strategy and where it fits. And again, educating potential advisors and clients that, decisions shouldn't necessarily be just performance driven and reactionary. It's really, understanding what this strategy is and what we're after. The demand for alternatives is strong, we do feel, and as market conditions shift, we definitely recognize the importance of alts. It's just a matter of, how advisors and their end clients can actually obtain true alternative strategies.
And just to add one point to that, it's certainly been somewhat challenging if you were to just look at median or average returns on an absolute basis across the Morningstar alternative categories. We certainly want our clients to leverage the investment team at Vivaldi's expertise in building overall alternative portfolios, because the one thing we've seen is the firms that have had a good experience with alternatives have been able to actually generate some alpha in their own portfolio construction of alternative strategies. And what I mean by that is one way to self-evaluate your alternative portfolio is by measuring what we call diversification benefit. So we do this on our side as PMs, but you can do it as an advisor as well, building a portfolio of AMFs. Is you take a look at your risk profile of your overall alternatives portfolio as measured by volatility. Then you look at each strategy on a standalone basis and evaluate or pinpoint that standard deviation. And if your overall portfolio is running materially lower from a volatility perspective than your standalone managers, you're likely doing a good job of selecting a good or effective mix of differentiated and complementary strategies. And if they're not, it might be worth reconsidering how you're constructing that alternatives portfolio and why you might be underperforming from a risk-adjusted perspective.
Fair enough. All right. Well, next question asks about focusing on regulatory concerns. The SEC's liquidity risk management rule to be implemented specifically here in 2019, and wanted to ask the panel how this will impact the AMF industry.
Hey, Lou, this is Christo. Maybe I can take this one from our view. In the 40 Act space, we tend to feel that the liquidity rule is not going to have that material of an impact to some of the strategies. We do feel that liquidity in the market overall tends to be more controlled by the manager level, and even if there's most illiquid strategies basically tend to close relatively quick, and they tend to be relatively limited in scope. In the 40 Act space, the traditional rule is that mutual funds have to maintain 85% of their portfolios in liquid assets. They have the traditional regulation right now is that no more than 15% has to be in illiquid securities, which can be liquidated in more than one day. On the alternative side, I also have to mention that many of the strategies that we work with, be that global macro, which is global currencies, global bonds, which are very liquid, or equity long-short strategies, which deal with equities, which are also very liquid, or any of the trend-following strategies which trade in futures, those tend to be broad, deep markets that have ample daily liquidity. So we don't think that the liquidity rule perhaps is going to be as impactful. It may hit some of the more niche strategies in fixed income. It may be a little bit more impactful to closed-end funds and interval funds. They are a little bit, obviously an interval fund has liquidity constraints for a reason, and putting a liquidity rule and having to have a little bit more ample disclosure as to what the fund holds may dampen some of the demand perhaps in that area. But in the open-end space, we don't think it's going to be as impactful, particularly in the broad strategies that we see. Maybe in fixed income, a little bit more of an impact.
Wonderful, wonderful. Thank you, Risto. All right, unless there's any comments from Alfredo or either Monica or Michael, I can maybe jump into the next question here.
Sure.
Yeah, so let's maybe talk. We've talked a lot about mutual funds, and there's been some mention of some other various products out there too. A great segue here. So within the context of a portfolio, how do AMFs complement and/or compare to the illiquid alternative offerings available to retail investors?
Yeah, here's Alfredo. I can comment on this one. Yeah, so I think the general idea is that I think there's room for every type of structure. So AMFs can represent a lower cost way of accessing discovered beta or better known strategies. And then for less liquid structures, you can use those to access less liquid assets, higher levered strategies, or just other strategies that are not very well known. Michael mentioned earlier interval funds, which actually my firm, Snyder Kearney, covers. Interval funds are kind of falling between the completely illiquid products and the liquid mutual funds, so those can be used to access a different set of products, and then a different set of investments. But as you go across these products, so you go from mutual funds to interval funds to non-traded REITs to hedge funds, and then all the way up to private placements. I think they all have their place, but the fees, complexity, and risk goes up with each of them. So it does require more research and due diligence to figure out how these strategies work and where they fit in the portfolio. So again, to summarize, I think AMFs are a good way to access a good lower cost way of accessing discovered beta and better known strategies, and then the private placement on the other end can be used to access the least liquid investments in a portfolio.
Wonderful, wonderful. Well, thank you, Alfredo. And I want to make sure there's time for Q&A. So maybe we might kick it over here. I just wanted to say quickly, for the listeners, I believe it is worth mentioning that we've covered a lot of complex topics today, a lot of complex issues around due diligence and researching these AMF products, and there are a lot of third-party research platforms available for performing such research. And this does include AI Insight, which has designed an alternative mutual fund platform that does cater to many of the issues we've discussed today, which certainly can be explored further through our website or customer care team. But with that, I think I want to kick it over back to Jen and make sure and see if there's any time or see if there's any questions from the audience.
Thanks, Lou. Yes, actually, we do have some questions. My first question is, during the fourth quarter of 2018, what alternative strategy performed well versus the equity markets?
So maybe this is Christoph. From our perspective, we did see that our multi-manager strategies did hold up reasonably well. We also did see some global macro strategies do well in the fourth quarter. In the global macro space, we do use a little bit more fixed income oriented strategies. As I mentioned earlier, we're trying to lower equity risk, so some of the strategies we saw in those spaces did well. But overall, it was a storm in the fourth quarter, and we did not get as good of a performance from our equity long-short strategy, and managed futures in general did not do as well as some of the trends that were previously positive in many areas, such as positive rate movement or rates moving up, as well as equities moving higher, started to revert. So in the fourth quarter specifically, alternatives maybe did not protect across the board as efficiently as they would do over a course of a cycle, at least from our perspective.
Yeah, this is Michael at Vivaldi. The only point I would mention, given we track the entire universe of 40 Act merger arbitrage or majority merger arbitrage funds, Some do some other event-driven trades as well with a little bit more beta, but we saw that universe hold up pretty well in Q4, where you had market volatility in the month of October infiltrate arbitrage spreads a bit, where you saw managers down modestly and just not trying to set expectations for that return segment, but you had those managers maybe down anywhere from 50 to 100 basis points for the month of October across the universe of funds. November was a good month for that space, where those managers were actually able to exploit some wider spreads and make a little bit of money, more broadly speaking. And then December was more of a month of blocking and tackling, where the macro was not really breathing on arbitrage spreads. So we saw there's anywhere from 10 to 12 daily liquid merger arbitrage funds, and that universe was positive in Q4.
Thank you. The next question I have is, why does back testing always look good?
Yeah, this is Alfredo. I'll take that one on. So back testing is used often as a marketing tool. So it depends how you use it, right? So if you're using back testing just to understand how your fund is going to perform in different scenarios, or how you as an advisor or analyst want to understand how that looks, how that impacts your portfolio, that's actually a good thing. So I would encourage that. Put in a multi-alternative fund in your portfolio and test to see what the impact would be. But when it comes to marketing, if you back test, you're going to kind of back test and see which combination of investments, both traditional and alternative, kind of worked best. So in that back testing, you're going to end up selecting what looks best, but it's backward looking. It doesn't mean that that's how it's going to perform forward looking. So again, back testing, it's not exclusively bad, but when it's used in a marketing purpose, definitely be aware of what the limitations are, and be aware that there's going to be an incentive to select the portfolio allocation that looked the best looking back, and not necessarily what's going to look better going forward.
Thank you, Alfredo. Next question is, what are some of the ways in which alternative mutual funds help protect investors from market volatility?
This is Christoph. From our perspective, we generally feel that alternative investments not only can add a good amount of return to a portfolio, but they also tend to mitigate risk overall. Most of the strategies that exist in the 40 Act mutual fund space tend to have fairly well-defined risk controls, and they tend to be, if put in a portfolio context, generally diversifying, so they tend to lower the overall risk of a portfolio. As I mentioned earlier, from our experience, anywhere between maybe 8 to 12% risk reduction, depending on the amount of alternatives that are used. And a lower volatile portfolio over time tends to have a more stable return pattern, and that more stable return pattern tends to add to compounding a little bit faster, of course. So by lowering volatility in general, that's where, in our view, alternatives are best used.
Thank you, Risto. And then our last question is, given the difficulties in benchmarking the performance of alternative mutual funds, are there other effective ways for screening alternative mutual funds outside of performance?
This is Christian again. From my perspective, performance alone probably is the more misleading way of screening mutual funds, because it does miss a lot of nuances that exist within managers. So, for example, in the equity long-short space, in the December timeframe or the fourth quarter timeframe we just discussed as a volatile period, a manager that had a lower equity exposure or tends to, generally speaking, have a lower equity exposure would do better than somebody who, even though the long-short manager maybe is running with a 60 or 70% net exposure to the market. So the investor has to understand the strategy. They have to have a good feeling about how that strategy compares to the peers, And just comparing two long-short managers, one compared to each other, doesn't always do the strategies justice. So it does take a little bit extra work, and I think that's why more specialized investment reports, either from firms such as AI Insight or using a multi-manager product, which has been pre-screened and maybe professionally managed, and there's another layer of due diligence on it, does make sense in this area.
Yeah, Alfredo, I'll jump in on this one. If you have access to more advanced tools to do some deeper analysis, I also like to look at the shape of the return curve and some statistics on there. So, we mentioned the Sharpe ratio earlier, but also look at correlations, skew, kurtosis, and there's some newer ratios out there that can help, like omega ratio. These are a little bit esoteric. It requires a little bit more work to get into it. But understanding like the distribution of returns and what these metrics that I mentioned, what they mean, that can help you better understand, how these funds are meant to perform. But it's also important to look at the length of the track record, right? That's we have to combine quantitative with qualitative. On the quantitative side, try to look at a fund or a benchmark that goes back a long time to kind of understand how that strategy works. But then you're going to need the qualitative side, and that's where tools like AI Insight come in to better understand qualitatively, how this might differ from whatever longer track record you looked at. So that's my 2 cents.
Thank you, Alfredo. That was our last question. Lou, is there anything else you wanted to add?
No, I believe that covers it on my end.
Well, thanks so much. Thank you especially to our panelists, Alfredo, Hristo, Monica, and Michael, with partnering with AI Insight to deliver this educational webinar. Also, thank you to our audience for calling in. Please reach out to AI Insight customer care team with any questions. The number is at the bottom of the screen on the left-hand side. Also note our next webinar on March 28th is AI Insight Continuing Education Features and Enhancements. So please register for that. Have a great afternoon. Thank you.